Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned homework problems from the digital study guide for Chapter 9, the short exercises. And note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help you if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And as I said in the previous two exercises, 9:11 and 9:12, you know, you have to understand the theory behind behind the concept of bonds, right? If you don't understand the theory, as we progress, things get more and more difficult, and it becomes, you're just not able to make the right calculations. So with that said, in 9/11, in 9:10, we showed the exercises showed a bond at par. Okay, in 9/11, they showed a bond at discount. And so in 9/11, even though I didn't go, I'm sorry, in 9:10, even though I didn't go over all of the theory because I covered the theory in the theory videos for this chapter. It showed bonds at par. Then in 11, it went up to a step where we had it at discount. And I actually, when I was doing that particular video, I was showing and alluding to the theory for the difference between par and a discount. Okay. But then we went to 9/12. I didn't go over all of that theory because for 9/11, which was at discounts, and 9/12, which was at a premium, right? Basically, they're worked the same way, except they're just the opposite. It's like accounts payable and accounts receivable being two sides to the same coin. Well, you could think of par being the edge of a quarter, okay, and an edge of a coin, and discount being on one side and premium on the other. So it's just the opposite, but they still work the same way. So in 9/12, I didn't go over a lot of that, working through the theory. Okay, I just kind of like did the problem, and you were able to see how quickly you can get it done. Me personally, I'd be able to do it even faster. But now for this problem, 913, we're taking it even, it's being taken a step further, because in 9/11 and 9/12, they were talking about the bond being issued on 1/1, okay, which means, for the entire year on 12/31, right, there were two monthly payments, right, the two semi-annual payments, 7/1 and 12/31. So you didn't need to adjust for anything because of the time frame, right? However, here in this particular exercise, the bond isn't issued on January 1st. It's issued on an off date. So that means when we get to the end of the year, we're going to have to make an adjustment because the bond isn't being paid on the very last day of the year. So we'll see that in just a second here. All right, so it says Allied issued, the 8% 5-year bond payable with a maturity value of $50,000. Right, so same bond, and it's for 5 years. And remember, the 5 years times semi-annual payments means that you're going to have 10 periods for the interest payments. You're going to have 10 interest payments, right? And they issued it at par. Okay, so it's at par. They're not getting into the even more difficult calculations of if this was at a discount or a premium. So they're showing this at par, but they were issued on May 1st, right? Assuming that the fiscal year ends on December 31st, journalize the transactions and include an explanation around the calculations to the nearest dollar. Okay, so what are we looking at here, right? It helps to draw a timeline. to understand what we're looking at. So here it's May 1st, and let's call this 12/31, the fiscal year end. Okay. So semi-annual payments, that means every 6 months. So if this is May 1st, okay, the first semi-annual payment is going to be on 11/1. Okay, so this here is a 6-month period. All right, and the next interest payment will actually end up being on 5/1, this 6-month period. Okay, so this is a 6-month period, and this is a 6-month period, 2 semi-annual payments, right? But the issue comes in, and this is where the degree of difficulty starts to become, where they're raising the degree of difficulty here, in that on December 31st, when you're doing your books at the end of the year, okay, you have to make an adjustment for this time frame in here from the last interest payment to the end of the year, all right? Because during that time, interest is accruing, right? So in this case here, that's a 2-month period, all right? So interest is accruing during that time, but it's not on your books, okay? So at the end of December 31st, you have to get that interest on your books, all right? Now, you're not paying the interest out on December 31st. Remember, you pay the interest out every 6 months. You're paying it out on 11/1, and you're paying it out on 5/1, all right? So this interest that is accruing during that time period actually ends up being, an interest payable, a liability, because it's something that that you still owe. Okay, so that's the concept we're looking at right here because of December 31st being the fiscal year, and our having purchased the bond on and off. It's not on January 1st. Okay, and let's face it, this is a common occurrence because bonds are bought all during the course of the year. They're not all bought just on January 1st. Okay, they're not all issued on January 1st. So you were shown the, as an evolution, okay, and being able to associate. You were shown, a bond at par on the first of the year, okay. You were shown a discount on the first of the year, and you're shown a premium on the first of the year, right? But realize that that's not, you're going to have to deal with this case of the end of year, and you're going to have to deal with it from the perspective of par, discount, and premium. In this exercise, they're going to show it at par in order to be able to keep things a little bit more simple, right? But if you understand this at par, then you should be able to apply this at discount and premium. And since these are short exercises, I'm sure that in the exercises and problem section themselves, okay, you will end up having to do this, making these adjusting entries for discounts or premiums at the end of the year, right, which is another step up. That's why I'm saying, and you've heard me harp on this in the last 3-4 videos, you need to understand the underlying concepts, okay? If you understand the underlying concepts, then as you watch me do the application of this, you get it, okay? But if you don't understand the underlying concepts, you're just not going to get it, right? You're not going to be able to apply. All right, so issuance of the bond on May 1st, right? We should be relatively familiar with this, okay? It's, we're receiving cash, so that's a debit to cash for $50,000. And that's going to be a credit to bond payable for $50,000. Okay. Remember, we don't have a discount or a premium. All right. If we did, we'd have to take that into consideration in making this journal entry. But this here is at par. All right. So that's A. All right. B. Payment of the first semi-annual interest amount on November 1st. So on November 1st, 2014. Where we are, I'm going to do, we are right here, right? So oops, this should have been May 1st, sorry. On May 1st, we were there, and now we're making this first interest payment along the timeline. So you should already be familiar with this entry, right? It is 50,000 at times 8% times 6 over 12, which is $2,000 of interest per payment, right? It's $4,000 interest per year, right? 50,000 times 8% is $4,000 per year, right? And we're making 2 semi-annual payments, so that's $2,000. Either way you do it, ends up being the same thing, okay? I'm showing, I've been showing you this, but realize that I'm assuming that this is semi-annual. What if this wasn't semi-annual? What if this was quarterly or monthly? Okay, you're probably better off always doing the calculation like this, because it just becomes set rote nature. I mean, I've done enough of these where I can do them both ways interchangeably and understand why I'm doing them. But if you want to mimic or copy, always work your interest payments like this. Okay. Right. So with that said, right, the journal entry, as we've seen before on the for par, we're going to credit our cash for the 2,000, and we're going to debit interest expense for the 2,000. Okay, and remember, this is at par. And if you go back to problem 9-10, you'll see how this aligns exactly along with that one. All right, we're doing everything at par. In 11 and 12, you would have to take into consideration the amortization of the discount and the premium. All right. Now, this was for 11-1. Now we're at 12/31. All right. The accrual of interest expense on December 31st. So on 12/31/2014, we have to accrue the interest expense for that time frame, that 2-month period, right? 11/1 to 12/31, right, is 2 months, right? Because we have 11/30, that's 1 month, and then from December 1st to December 31st is a second month, so that's 2 months. Okay, so we're accruing the interest, all right? And this is why I suggested that you work your problems in calculating your interest like this. Why? Because now we're figuring out the interest for that 2-month period, right? So I have 50,000 times 8% times 2 months over 12. Okay, and if I do the math this way, I end up with, and I'm rounding, I end up with 667. Okay, if I do it the other way, I end up with 4,000, right? Then I have to divide that by 12 in order to get per month, and then multiply that per month by 2 in order to end up with 667. So many additional steps that I don't need to do. Okay, yeah. Remember, semi-annual, where you saw me, get the 4,000 and divide by 2, that's math I can do in my head. Okay. Doing this way is something I'm more likely to punch on a calculator. Okay, and in this case here, as you saw, I'd have to do a lot more steps trying to do the math in my head, and I'd still end up using the calculator in order to arrive at 667. So get used to working your interest payments, calculating your interest in that format, and you should already be used to that because you had that in Math for Business and Finance and previously in the financial accounting textbook. All right, so we calculate the interest for those 2 months to be 667. So that's a debit to my interest expense for 667. And my debit has to equal my credit, so it's a credit. And this is something I owe, okay? And what do I owe it for? I owe it for interest, so it's going to be a credit to interest payable for 667. All right, and that's my journal entry for December 31st for that 2-month period. Okay. All right. So hopefully you had gotten all of that, and if not, then you know, go back over and watch the video again. And as you keep on hearing me harp here, you know, watch the other videos, get the theory down. Okay. And with that, I will probably make one more video in order to do problems 14 and 15. All right. So I'll see you then.